working or not. So somebody let me know. 1 second. I don't know how to connect the chat. I'm using an external software, so I'm on a little bit earlier just to check if everything works properly. Chat. Oh yeah, sure, I can see public chat. I don't know if there's a delay because I've never done this before, but I need to do it. Oh, there you go. There's a few people. Cool. Oh yeah, that's wicked. That I can actually pull out comments. Bear with me. We'll start properly in about a couple of minutes. Just give times to get people on the stream. So I've never done anything live like this before, so it'll be interesting. So essentially, the point of this is I get hundreds and hundreds and hundreds of messages every day, and do my best to try to answer as many as I can, but there's too many to get through, and a lot of the questions I get are very similar. So I thought, you know what, I'm going to do, oh, there's my camera. I'm going to do something like this in more of a live setting. So, you know, if I answer a question, it's the same questions you'll be able to see. So I hope the audio's okay. Let me have a look. All right. I haven't really got a script. I'm going literally off the cuff. So the point here is just to really answer questions. And yeah. Wow, there's obviously a lot. 1 second, let me scroll up. Okay, so the audio's good. That's a good start. Right. Hello, Ali Khan. How are you? That works. I'm great, thank you. How are you? What time? Okay, let's see if I got a good question here. Oh, there's a lot of people here. I'm sorry, I'm trying to read the questions in the chat, but it's going quickly. Ali has changed my trading. Salam alaikum salam. I am Muslim, yes, for that question. You look shy. I am. I'm very introverted, which is why I don't do a lot of stuff live. But you're not going to grow from a place of comfort, so you have to sort of put yourself out there a little bit. Okay, let's see a question. What is a high probability CISD? So first thing, changing state of delivery. That's what CISD is. And there are various different types of change in state of delivery. The earliest change in state of delivery is going to occur when price has raided either a buy side or sell side liquidity pool. So essentially what we refer to as a turtle soup, that is your first change in state of delivery. That's when the algorithm is going to shift gears from a buy program to a sell program. Now, there's technically three confirmations of a change in state of delivery. Number one is where you have a change in, the order block, opening price of an order block. So when price breaches through it, it doesn't have to close through it. I've seen a lot of people saying that it needs to close through an order block. It doesn't. The opening price is like a trigger. So that's your confirmation of the change in state of delivery, or you can use an inversion fair value gap. Once prices close through consequent encroachment of an inversion fair value gap. So say, for example, if we're inside of a buy program, right? Type 2 dealing range, equal highs above the market, and we're inside of, now the buy side delivery price is shifted. if we have that inversion fair value gap, so the first inversion fair value gap prior to that raid in liquidity inside of that expansion, like if we close through consequent encroachment, essentially that's an early sign of a change in state of delivery as well. And often I wouldn't need for price to trade through the opening price of an order block. So yeah, I hope that makes sense. There's way too many questions. I didn't think there was going to be anybody on this stream, to be honest with you. I'm just trying to find some as I'm scrolling through. It doesn't help because my when I find a good question, it goes all the way back down to the bottom. Just found your channel very informative. I appreciate that. I'm just trying to provide as much value as I can. The big reason in my my motivation to do this is because I've been through the journey myself, right? It's difficult. And really why I was inspired to teach is I want to stop people gambling. There is an easier way to do this, but it just requires time and it requires experience. And a lot of you are throwing money away at prop firms without really having the right education. You need to invest into yourself, into your education, into your growth, and give it time. And this is going to come by way of experience, right? It's the process that you have to fall in love with. If you are trading to chase the money, you're not going to make it as a trader. You have to chase the process. You have to really love what you do. And if you're going to go in here and really chase the money, you're going to try to, take shortcuts. You're going to get burnt. And that's what happened to me many, many times because I thought I was going to do this quicker than everybody else. And I found out the hard way that if you go into this with that kind of mindset, you're going to take shortcuts and you're going to get slapped for it. So I'm trying to do my best just to provide as much value from my 10 years of doing this, and hopefully out there it'll help somebody. I mean, we've had a massive response with DRT, which has been quite overwhelming. When I came out and taught it last year, I didn't think it would have the reach that it's had. On a daily basis now, we've got people, with payouts and how it's changed their trading around. And the one that surprises me the most is the experienced ICT students. I've had charter students who have messaged me and saying, DRT has completely changed the game because it's allowed them to have a framework to obviously the concepts. Now that's the point, right? DRT was derived from essentially really, really studying market maker models. And I did years and years of deep study around them. And I realized that everything is reliant on price itself, right? The algorithms operate on a price engine. And it just made a lot of sense that there's going to be specific reference points in price. And that's obviously the dealing range and the DRT levels. And then when I started to investigate where the high probability setups are going to form in relation to high probability PD arrays. And, that's where really DRT came from. And I was inspired to just go out there and really teach it just to see if it would help anybody else. But the feedback has been unbelievable. So really, really proud of that. I'm trying to keep up with some of these questions. I can't, it's just so many. Let's see. How to find a high probability liquidity pool. So liquidity pools aren't equally weighted, right? This isn't just about liquidity pools. It's about PD arrays and key levels in general. They are going to form within the time windows salient to the time frame that you're looking at. For example, say like if we're in, let's call it super low time frame scalping models, you want to look at your previous session liquidity pools high and low, your previous daily liquidity pool high and low, your previous 3-day liquidity pool. Think IPTA data ranges 20, 40, 60 the last 3 months. Similar with lower time frames because time is fractal and so is price. And then your previous weekly, right? Now, also, if you're trading, say, the macros, your previous macros, look at the highs and lows because most of your turning points are going to form inside of macros, right? So that 20-minute window at the top of the hour, 10 minutes before, 10 minutes after, you're going to find a lot of really high probability setups there. Again, it's going to come down to how you really want to trade. for me, I'm very much a reversal type trader. So I'm looking for liquidity pools to be engaged first. And then realistically, for me to filter everything down, I'm looking for type 2 dealing ranges. They're easier to spot. And when I'm inside of, like, say, if I'm in a type 2, like a bullish type 2, as soon as those equal highs form and we see that break in market structure, I know that we're likely to see, a type 2 play out. So if you've been through like my market maker, my courses and stuff, you'll see how we can grade the initial consolidation and then project deviations to see where terminus is likely to form. And if that overlaps with a higher time frame key level, then all we're really witnessing there is a change in state of delivery within a designated time window, and that makes things easy. I don't know if I'm talking too fast. Obviously, this is live. When I'm doing my normal teaching and stuff, is very clear and professional, and I guess this is just me being casual. I'm just talking. Anyway, I hope that helped. I need to find a better system of keeping up with these questions. I might have to get one of my team to pull out questions here from the UK. Hey Jed, I'm gonna be coming back to the UK hopefully soon. I actually really miss it. I never thought I was gonna say that. As much as I love Dubai, home's home. And I never thought I was gonna say I miss the rain and I miss the autumn. It started to get quite hot here in Dubai. But yeah, I should be back to visit family soon. Timothy from Nigeria. Hi, Timothy. Okay. Would you incorporate order flow? So we've got a question. Would you incorporate order flow to your DRT concept? I personally don't need to. When you're talking about order flow volume profile, in my opinion, I think it's nonsense. That's just because, how do I say this without offending people? Actually, I don't care. If you get offended, you get offended. If you really understand ICT, you understand algorithmic price delivery, then what you're really looking for is algorithmic order flow. Once you can establish what the market has already done, you can then establish what it's likely to do next. Now, I'm not trying to put people off using other things in conjunction with ICT and or DRT. If it works for you, great. At the end of the day, the point here is to make some money, right? I know traders who trade support and resistance and make money. Essentially, the edge is in your psychology and in your trade management. But when you have a really good technical understanding of the market, and when I refer to order flow, I'm referring to algorithmic order flow. Essentially where has price already visited and where it is likely to visit to next. If you can understand that, then in my opinion, you don't need anything else. That's why DRT becomes really high probability when you can align that with algorithmic based, delivery. And what ICT talks about, that price delivery continuum. Essentially, like if you've been studying ICT concepts for a while, despite what you may think of, the mentor, Michael, the concepts are unbelievable. They're so precise. And the problem is it takes a lot of time to make them work for you because, different sort of models are going to work for different people. Different PD arrays are going to stand out for different people. I have my personal PD arrays and the preferences that I like. And when I've tried to, in the past, force my students to sort of look at those, it doesn't work. So, trading is very much individual. So I don't discourage people to combine other concepts with, DRT or ICT concepts. I know traders who will use, still EMAs and stuff, and they're using that in conjunction with algorithmic price delivery and, that price delivery continuum. So I'm not discouraging people, but my point is when you understand this to a high enough level, honestly, you don't need anything else. You literally don't need anything else. And for me, DRT is like the culmination of 10 years worth of understanding into the most simplified framework based on the market maker model, essentially is where DRT was derived. And with the feedback that I've had, and I know a lot of you guys have been using it, you can really see how powerful it can be. So, oh man, I need to scroll all the way back up. There was a few questions. Okay. There's some really, really good questions I just really wanted to get, but it's going too quickly. I'm just going to have to pull some more random. I love you. I've got a few friends in this chat. I just realised. Okay, here's a decent question. What are the key things which can be misinterpreted while using dealing range theory? It's a great question, and the answer lies in higher time frame delivery. Okay, essentially, you have to know what the underlying market narrative is. Without that, it doesn't matter what range you're using. It doesn't matter how well you know DRT. It doesn't matter if you're the best person with ICT concepts in the world, because every single model is going to rely on what that higher time frame narrative is going to do first. And that's where it can be misinterpreted. Not essentially DRT itself is a very simple framework, right? Essentially, it's a simple model, and I pretty much taught the majority of it on YouTube for free anyway, and people are having success with it. But the success will come and it will amplify based on your knowledge of higher time frame criteria. So you need to know what on the higher time frame is the market reaching for. Sometimes you will be in, say, a bearish type 2 dealing range, and you can clearly see equal highs. So you're convinced we've had prices closed above the 25 DRT level. That signifies a change in state of delivery. We've got a fair value gap, an inversion fair value gap. They overlap. And you're convinced, and you're like, this is definitely going to those equal highs. But what you've completely missed is that those equal highs sit above consequent encroachment of a balanced price range on a daily time frame. It's never going to go back up there. That's when those equal highs are going to remain intact. So without understanding that narrative, anything that you're going to do in terms of any model on a lower time frame is going to fall apart. And I think that's the thing with ICT concepts in general, because people become very, very quick to label that it doesn't work or ICT is a fraud, it's a scam. No, you just don't know how to use it properly yet. And that just requires time and patience like anything. But when you learn it to a high enough level, everything clicks. It does eventually click. It's just at the beginning, it seems really, really overwhelming, right? There's a lot to understand. There's a lot to work on. But like I always say to a lot of my students, nothing worth having comes easy, right? So, do you implement new ICT arrays into DRT? Do you still implement new ICT arrays into DRT theory? Absolutely, yes. I just dropped a new one called BOLO, which, to be fair, he's pretty much vaguely mentioned it in the past. Now, if you understand external range demarkers and you really know how to use them anyway, the consequent encroachment of a wick when you've got a rejection block in there, realistically is a defensive PD array. And if you've been using that in the past, then by default, you've already been using BOLO, or you've been using any of the, Venom model or Gauntlet PD arrays, Grey Pools, whatever he's coming out with. Essentially, they're variations of similar things that he's talked about in the past. But let's be fair as well, Michael's a master marketer as well. He knows how to really garner attention and really gain an audience. So that's his thing. Do you need to know every single PD array? Absolutely not. What I came to realize, and this is just like a personal one for me, I spent years and years and years studying because I'm an academic, right? I come from a very educational background, and with academics, the way we process things is that the more we know, the better we're going to become. And after years of studying, I was still unprofitable, and I came to the conclusion that why am I still unprofitable when I know basically every single concept like the back of my hand? And it came down to the fact that I just didn't have chart experience. And when I really delved into my notes, into my journals, I quickly realized that for me personally, I was afraid to get into the market, right? And because of that, I thought that if I was studying, I was being productive. And that was masking the fact that I was just my fear of losing. And what I came to quickly realize is that the fear of losing is what cripples a lot of traders, because you have to get over that. You're going to be wrong. The only thing guaranteed in trading is that you're going to be wrong. Your job as a trader is to mitigate losses. Your job as a trader is to have the correct risk management. So when you do lose a trade, inevitably, it's a small loss. And when you do win a trade, you know how to pyramid, you know how to add to those positions when they're winning positions. And that's essentially trading, right? The ADHD got the better of me and I completely forgot what the question was. Sorry about that. I don't think I can find it because it's, damn, there's loads of questions. I didn't think there'd be many people on here. I thought, honestly, there'd be maybe 5 or 10 people. So I'm quite taken away. Do you think the war will change trading for us? It's a good question. And something that I've been talking about with a lot of my private students over the last few weeks. These conditions, in all honesty, they bring in volatility, and that's what we need as traders. I've had a lot of people message me and about, is the algorithm going to change? Personally, I don't think so. I think there's two. I mean, look, at the end of the day, there's how many ICT traders in the world are there that understand, this algorithm? Yeah, how many ICT traders actually can really make money? Do you understand? It's not, the skill isn't in the edge. The skill's in, again, like I said, your psychology and how you can manage risk in the markets. So in my opinion, there's too much money. There's way too much money to be made. So I can't see the algorithm changing. But what's going to happen is there's a lot of volatility, which in some cases, when we have like geopolitical conditions that create uncertainty, that uncertainty sometimes keeps money off the table, right? And the institutions that have deep pockets, unless they understand what's really going on, they tend to, not get involved or participate, which leads to choppy conditions. And we've seen this throughout all the tariff stuff that was going on because the markets were crazy. I mean, you look at like the stock market during that time. But at the same time, when we see the markets open up, which I genuinely do think is happening right now, I think we're going to have a lot more sustained moves over the next few months. So I think it will affect how we trade. But personally, I mean, without trying to get political, we need volatility as traders, right? Every time I try to read a question, it goes, where am I? If you're enjoying this, give me a a thumbs up, and a comment, because I didn't think I'd have so many questions and people asking things. Let me see, here's one. When to use Wicks as a PD array? That's a good question. So Wicks are gaps. And when you understand essentially Wicks are gaps, you're gonna know, okay, when the market's dropping lower and we have an order block below the market, the first thing the algorithm is going to reference is that premium gap, right? It's going to work within those levels, and they sometimes can have really, really nice setups on a lower time frame. So when I'm looking at, say, an order block that has a wick on either side, and next to the order block we have a buy side imbalance, then I'm going to reference the whole range of the order blocks, or wick to wick, and I will grade that entire order block with, quadrants. If I'm in a market where there are overlapping wicks, then generally I will just use the bodies, because that's where the volume is and it generally gives me cleaner entries, right? or I would grade the Wicks, and that's when we can sort of find hidden fair value gaps and stuff like that. But it gets a bit technical. But yeah, that's essentially what I do. If there's the many Wicks, use the bodies. If there's no Wicks and you've got quite a lot of gaps, then use the entire range. I enjoy this. I appreciate that, man. You understand that when you how to spot a seek and destroy session. It's a great question. So there's rules, and essentially a seek and destroy is a type 3 dealing range. There's variations in the different dealing ranges, right? I've taught the type A of a type 3, and there's a type B as well, where we expect a seek and destroy. Now, is heavily going to be based on two things. There's others, but without getting really long-winded and getting into other stuff, a lot of it is heavily dependent on the kind of economic climate that we have. So based on the economic calendar, we can generally see we may be in one of those weeks where we're likely to get seek and destroy. And you're going to have to do research and looking at what type of news events that can occur with. It's going to come down to, again, the weekly profile. Excuse me, if you've got a really large previous day or overnight range, and we're at the extremes of a dealing range, a seek and destroy can also occur. The main purpose of a seek and destroy is to clear the board. So generally when there's going to be a big move in one direction, you will go into a seek and destroy because they don't want active market participants. And they're also engineering and creating a liquidity pool so that they can obviously raid that and offset or, distribute or accumulate. So that's one. The other one is very similar to what I said, is when we're at the extremes or we've completed buy and sell programs. Generally, that's where you're going to find a new layer of accumulation or a type 3 to form. And if you really read between the lines and you've researched DRT and you've spent a bit of time with it, you're going to understand that a type 3 dealing range essentially is an initial consolidation of a brand new market maker buy or sell model. It's just how we trade inside of that range. Personally, I don't like them, for transparency. I don't really like to trade inside of a type 3. If I know I'm in a seek and destroy, which in all honesty isn't always the case, right? Sometimes you're going to misread the market, and you're going to have some expectation, and obviously we're human, right? There's still human error that's going to take place. The minute I realize I'm in a type 3, I will sit on my hands, right? I'm out the market, because even though there are, I just did one last week with my actual community, and we were talking about the type 3, and the precision element still, even within a seek and destroy, is unbelievable. But they're very risky to trade, in my opinion, still, which is why if you do find yourself in a seek and destroy, sometimes it's not always easy to determine. Stay away from the market, because you're going to get chopped up. And that's most of my biggest losses has come by way of revenge trading when I'm inside of a seek and destroy profile. And, that's just the arrogance and immaturity that I had as a younger trader. So there's nothing wrong with losing in those environments. But when you're inside of a seek and destroy and you're going to keep going in there and trying to risk money, that's when you're asking for trouble, really. This is a great question. Give me some psychology ones if you guys have got psychology ones. I do a lot of technicals, but there's also an absolute ton of psychology that I've learned. But if you were to start over, what would you focus on? I've wasted a lot of time and energy going down a ton of rabbit holes over the years, right? A lot of it, ICT's fault, because he would leave these clues and these breadcrumbs. And I personally, now looking back, it was most likely marketing and to get people talking. And again, that's Michael's nature. But don't go down these rabbit holes, right? Even if you don't want to use something like dealing range theory, just stick to the basics, right? If I went back and spoke to my younger self, I would say, first, get over the fear of taking a trade and get some experience. I would have definitely journaled sooner, right? It was like 2, 3, maybe probably about 4 years actually into my actual trading career where I actually started to journal. And that for me was the biggest shift, because I was able to have data and I was able to look back at my charts. I would look back at my journal and say, oh, actually, this is where I went wrong. You know, this is what I need to change. So that would definitely be something I would have done sooner. And I would have kept it a lot more simpler. I would have placed more emphasis on looking for liquidity targets. I would have placed more emphasis on looking at inefficiencies. What I was doing, and maybe this was because of the way I was taught, obviously we're going back, you know, almost 9 years now when I started with ICT. He had only released probably about 20% of the information compared to now. So you guys have a whole lot more information regarding algorithmic theory than I did. And in many ways, I think at the time, because obviously there was still a lot to absorb, you know, I mean, it's crazy now. So I guess in one way it was beneficial. I was placing more emphasis in terms of PD arrays and order blocks and breakers and this and that. When if I had placed more emphasis on where is the highest high, where is the lowest low relative to where I'm currently trading, so essentially the dealing range, right? And then I would have placed more emphasis on understanding premium and discount and use that as a primary filter. Now, you're going to obviously evolve from that, but to keep a very simple, easy, basic model, that's what I would have employed personally. And I would have just, like, you know, a lot of self-talk. I think I was, like I said, very scared to get into trades because I just didn't want to lose. And getting over that fear, the quicker you get over that fear, the quicker you're going to make it. I have traders still that I work with who have been trading for 5, 6, 7, 8 years, and they still can't get over the fear of losing a trade because they need to be right. And this is interesting because most of my traders who do this, they're usually academics, right? I've got doctors, I've got people who are engineers, and I've got people who are pilots, and they very much have, you know, a very strict criteria that they're following. But to take a loss is almost damaging to their ego, and you absolutely have to get rid of that ego. You cannot come with ego into the markets because they will humble you. So I think if I went back in time, that would be one of the first things that I would have done is says, listen, this is my trading plan. This entry and this setup is, you know, basically these are my rules, and I would have followed my rules. And if I follow my rules and I'm wrong, I'm still right. And if I employed that mindset earlier, man, I would have made so much more money, way more money earlier in my career. But that's basically it. Journal. Really know about what? Please show and tell how you journal. I'm going to go over this during the 5-day live event. A lot of that mainly is to do with trading plans. There is obviously going to be teaching elements, but a lot of the teaching elements I've already taught on YouTube. It's like trying to, how do we take all of that information and put it into working models and an actual trading plan with understanding how we journal. But essentially, there's no real right or wrong way to do it. The way I do it is I take a screenshot of my chart, and I basically, on TradingView, I get a text box and I just type what I can see. That will go into, well, I'm working on an actual, the old way of doing it is I'd write everything down, I'd put it into a folder, then, you know, how I'm feeling for the day, the trade, the time, the trade setup, the economic calendar event. All of these things is really, really great data because you're going to go back and you're going to start seeing a pattern. And, you know, that's the hard part, that's the homework. But now I've got an actual journal that I've just built. It's an app which basically does everything for me, including a calculator and all the other things in there. So I have everything now in one place on a calendar. But yeah, that's another story. Please, sir, Urdu. Bro, no, I'm not even going to attempt it. I can understand it, but trying to speak it, you're all just going to laugh at me. So let's not do that. PD array hierarchy. Again, a great question. The hierarchy of PD arrays is going to be in line with where you are in the dealing range versus what price has already traded to. So you're going to have your high, essentially, right? So price is traded into a high, it's come back down. Then you've got your quadrant levels of the wick, right? Then you've got your rejection block, right? Then that rejection block may be the high time frame order block. And you've got your mean threshold and your quadrant levels of your order block. When you're looking at hierarchy, what you're doing is you're looking at where the algorithm is indexing price in the current, inside of the current dealing range. But then you also have to understand what the market environment is going to be. Why will it not reach that fair value gap? Is it a balanced price range? It overlaps with that 25 DRT level. Is it a breakaway gap? If there's a breaker sat there, why will it not respect the breaker and move higher? Because there's an inversion fair value gap inside of the leg that reads buy side liquidity. So there's not really a clear way of saying, well, okay, a breaker stronger than this level or an order block stronger than this level. It's going to be very much down to what current price action is doing relative to the dealing range and what type of arrays are referenced inside of that range, because you're not going to find every single array in price. And this is why I'm saying, like at the beginning of this, was understanding price delivery is the most important thing when you're trying to trade. Okay, because that's where basically your setups are going to come from. That's where your order flow is going to come from. That's where narrative and bias is going to come from. Is just really understanding that price delivery continuum from higher time frame down to lower time frame. But it's important to stress that you always have to refer back to that higher time frame. Sometimes you're going to see things on the lower time frames that's going to completely invalidate your bias. But then when you go to the higher time frame, you realize, I was just in those lower time frames getting chopped up, where the high time frame clearly is telling me something else, right? Anyway, that was a long way of saying that. What are gold macro timings? They're all the same. The only distinction in terms of when I look at certain sort of ranges and time ranges is really between which, to be fair, I've done studies on the past and they still seem to work, even though they're more directed towards forex, is the central bank dealers range. And how we're going to use the central bank dealers range and the Asian range in relation to what we're going to see in London and New York. But that's going to be for forex. But even if you look at a forex chart and you look at a gold chart and you look at the stock indices, those macros are going to be the same. They're the same macros, they're the same price engines, right? They're going to run at the same time schedule. The difference is there's going to be higher probability ones, and they're the ones that we've already been taught, right? So within the London session, within the New York session, within the PM session or the AM session or pre-market session, they're the ones that essentially are going to work on all asset classes, because you have to remember that all asset classes, they're running on different price engines, but essentially it's all the same thing. When you pull one, it's like they're all on a string. You're going to see fluctuations, which is why intermarket analysis is an extremely important part of your analysis. But I wouldn't, not as far as I'm aware, I don't think there's any actual macro times just specific for gold. So I would use the same ones that you're going to be using in the stock indices. Hi Ali, could we trade opening range gap in forex? It's not something that I've ever used before. And something like that, in my opinion, I think it's better to keep that with stock indices, because there's obviously a clear, closing and opening with that settlement price, and obviously the start of that new day at 9:30. It's just an extremely powerful tool to use if you're going to be trading that, that opening range and or the silver bullet times. So they're really heavily influenced in there. In terms of using it for forex, I personally never have. It'd be interesting to see if other people have used that and have any success with it. But as far as I'm aware, it's only really salient to stock indices. So why does market structure shift fail? Another great question. Something that I struggled with for a long, long time, and I've already really answered it, is because I'm forgetting what the higher time frame narrative is, right? I'm forgetting the higher time frame draw on liquidity. For example, say I'm on a 15-minute time frame and I see, price runs into a sell side imbalance to the left. We reject consequent encroachment, market drops lower, breaks the near term swing low. But, so on that 15-minute, it looks like a clear structure break. But if I was only looking at that 15-minute chart with no other reference, then yes, I would be like, well, this is a structure break. And essentially, I'd anticipate price to run for sell side. However, you go to a 4-hour time frame, you're going to see that actually there's a 4-hour fair value gap there, a buy side imbalance. And we're actually inside of a buy program, a higher time frame. And all that was happening on that lower time frame is it was going back to consequent encroachment of that buy side imbalance, and it left it open. And in fact, if I see something like it didn't even get to consequent encroachment of that 4-hour imbalance, that's super bullish for me. So all that's happening on that lower time frame is prices going in there to collect stops and partially rebalance a higher time frame fair value gap. And that's when you look at it with that context, and this is why I say that high time frame narrative is the most important thing. Without it, your smaller time frames, market structure shifts and breaks, they're not going to work. You're going to get trapped out. So that was a learning curve. And again, that comes by way of experience. But I'll always say to you that if you're going to, you need different time frames for reference, right? You have, in my opinion, I think you should have at least 3 time frames. You should have your higher time frame for a directional draw on liquidity. You should have your mid time frame to have a stage for a setup. This is where you're looking at what price has already done and where it's likely to go next. And that's when you're really tracking order flow. And that's where you should essentially see your setup form. And the lower time frames, and this is the mistake that a lot of people make, is that the lower time frames are only to refine the entry and refine the stop. You should have seen your trade set up on a higher time frame. And what people are doing is they're going to that lower time frame and then trying to set up the entry on that time frame and missing the context of that higher time frame. And that's a lot of the time where you can really mess up. Yeah. I'm just clicking anything at random here. It's going too fast. What do you think about AI role in trading? Can it make people profitable in the future? Oh, it's a tough question. Honestly, I don't know. I actually asked this to ICT many years ago. And this was during his private mentorship days. And what he said to me it resonates and it's kind of stuck with me all the way until today, because we asked him if it could be automated. Could you actually automate a bot? And to some extent, what his actual reply was is that there's too many moving parts, there's too many variables, and in some cases there's going to be an element of discretionary trading involved in what you're doing. Do I think that you can automate certain parts of it? Absolutely, especially with the AI and the technology that we have today. Can you make a complete model? I think probably we're going to head towards that. I'm currently working on my own projects where I'm incorporating AI, but it's very difficult, Even looking at some of the bots that I've been running, there's times where I wouldn't have done that in my normal trading. So maybe that's a limitation on where I am in terms of my development there. But I do think it's going to play a bigger part in the future. I think I think people have got the idea of it's just gonna completely automate their trading completely, and maybe we'll get to that stage. But what I personally think, it'll be more of another tool that you can use, where it will give you better setups, looking for better exits, and help you to basically use as a little bit of a tool to help you in your trading. But I don't think it's going to change things massively in that regards. Which is why I think having that knowledge in itself is still going to be really crucial going forward. I mean, AI is good, but in my opinion, especially using it myself, I think it's massively overrated at the minute. I think there's just this massive hype around it, but a lot of the times it's just, I mean, I've fed my own information to it, stuff from like journals, from videos, from all the stuff that I've done, and I'll ask it a question sometime, and it's like wrong, and I'm like, I couldn't trust that at the minute. But it's a great question because I think there's definitely a whole lot of room for that in the future, at least. Um, are you from Pakistan? No, I'm from England. I'm, my mum's from Pakistan, but I think I've visited probably once or twice as a kid. So yeah, I can't tell you much about it. What do you think? That's not really a question. Does time refer to calendar days or session? It refers to both. So, you're going to have day of the week phenomenon, which is where we get Tuesday, Wednesday, Thursday generally forms the high and low of the week. That's algorithmic. Or we're going to have the session phenomenon, where we're going to have, for example, we'll have the low of the day form in London, the high of the day form in London close, and then New York will be a continuation. London is the manipulation, Asian range is the consolidation. That's a typical classic, buy day. And there's going to be variations within that. But essentially, it is relevant to what type of time frame that you're trading. We could have a really bullish expansion on say like a one shot, one kill, more swing trading model, and you could be in a lower time frame but only trading a small section of that. It doesn't necessarily mean you have to trade the buy program. If you're on a day trade and say the low of the week is expected to form on a Wednesday, you can trade that sell side delivery into a high time frame PD array, and that could just be your trading model or your scalping model. So you have to see, it has to fit the context of what your trading style is essentially, right? What do you think? What do you think about the current market conditions relative to the past years? I've been hard time. These are the hardest markets that I've ever seen in the last, well, it's coming up to 10 years of trading. I think I'm probably just over 10 years now, probably. It is the hardest market conditions that I've seen. Obviously, there are geopolitical and actual real life supply and demand factors in the markets, right? We can't ignore those, even if we understand how algorithmic price delivery works. When there is geopolitical tension, when there's uncertainty, when you've got Trump at the helm, and he can drop a tweet any minute, all of that makes it way harder to trade in general. But this is where you have to use your maturity as a trader to understand what type of market environment we're currently in and whether you want to participate or not. You don't want to trade just for the sake of trading, because many of us have done that, right? We're bored and we're hungry for a trade, so we need to get into a trade. And if you have that mentality, you're not going to be a trader. Now, my trading is very much based on what I can see seasonally first. And I have to then look at the geopolitical landscape. If I can see on, like, say, a daily or a weekly chart that it doesn't look clean to me, I can make a case for both sides of the market. I'm quite happy to sit on my hands and wait for multiple weeks if I have to, until I can see something clean, right? Yes, I can go down to a lower time frame and scalp, and I used to really be on those lower time frame 1 minute charts. But me personally, my trading got better when I went to slower time frames and I started to do more swing trading. And that's essentially what I really do now. I haven't day traded for quite a while. And it's really fit my lifestyle. It's fit my personality. As you guys, a lot of you know, I have ADHD, which makes it those lower time frames sometimes super challenging, because I'm like I'm chasing price all the time. Every fluctuation I want to enter. And I got to the stage where I was like, I'd rather just set limit orders on a higher time frame and then just not look at the charts. If it wins, it wins. If it loses, it loses. And then for me personally, it's been good that way. But when you're in market conditions where the higher time frames are quite choppy, or we're in a type 3 consolidation, they're way harder to trade, and they can be frustrating because you have to make then the decision. Do I go down to the lower time frames and change my model, use some of my lower time frame models, or do I just sit on my hands and wait? And that's going to be different for everybody, different with circumstances and where you are in life. You know, if trading is really your bread and butter, which in my opinion, I always think that you should have another form of income, right? And for me, you know, transparently, it was education. I never knew I was going to be a teacher. It was the last thing on my mind when I was leaving pharmacy. But in my early days, having a second stream of income massively helps you when you're in a period of really poor price action, right? So, you know, I get this question asked a lot of the time is like, should I quit my job and approach this, just go all in? And I'm like, dude, until you've got, you know, a good buffer in the bank, and until you really understand what you're doing and you've got 6 months to 12 months of data collected to show that you're consistent, don't even think about quitting your job, right? Because trust me, and I think people who have done this and been in this position, and there's a big difference between trading when you've got capital in the bank and a safety net, and trading when you have to make money to pay the bills. Dude, completely different psychological warfare. And I've been in that position. And looking back in my own journey, I think I probably quit my job a little bit prematurely, because I was in that boat. I was in like, although I was profitable and I'd saved up a little bit of money for trading for a few years, the psychological pressure when you lose a trade and that's your only source of income, man, that can cripple you, you know? So again, I forgot what the question was. I'm sorry about that, but I tend to do this. I can digress. Please help to understand type 3 DRT. I've got a whole video on type 3, so go and watch that, and it breaks it down where your entries and exit forms, and what essentially is a type 3. But what you're really going to do, and I'm going to cover a lot of this in the 5-day challenge, really is when to expect them and when we want to sit on our hands and wait. That's a point of having like a trading plan, and a point of actually looking at price charts and saying, do I want to participate today or do I not? And really you should know that within 30 seconds of opening a chart, whether you want to be an active participant and you want to look for a trade, or you're just going to say, nope, not for me, close your charts and walk away, which for me personally has been absolutely massive, because I tend to do dumb shit when I'm looking at charts and I can't see something clean. I'm just going to force my will on the market because I'm bored, and I've been sat here for an hour, and now I deserve, because I've obviously been patient, I deserve an entry, I deserve a setup, and that's not how it works. So, you know, understanding and identifying type 3 dealing ranges and high resistance liquidity runs is very important. And one of the ways you can identify a high resistance versus low resistance is, first, if you can see clear draw on liquidity. If you see equal highs and equal lows above the market, where, say, for example, you have an equal high above the market, right? Or relative equal highs above the market, where the high to the right is lower than the high on the left. That's a low resistance liquidity run signature in a type 2 dealing range that I like to look for. That's number one. Number two, how is the market trading? If it's back and forth, gaps aren't staying open, we're going to be in a high resistance liquidity run. And again, that's not to say that price still won't reach your profit target, but from my own personal experience, being in those conditions and the amount of mental capital that it uses is just not worth it. So often if I find myself in a high resistance liquidity run, I just tend to close my trade. And if it goes to profit, it goes to profit. I'd rather just, you know, and again, that's just maturity. I've gotten to the stage where I'm like, I don't care. There'll be another, you know, setups are like buses. There'll be another one around the corner. So you don't need to worry. And mental capital, without that, you're not going to survive as a trader, right? So, yeah. What is the criteria of when not to trade? You're going to have to join the 5-day challenge to find that out. That's a whole, I'm doing a whole lecture on it. But jokes aside, this criteria you have, there's a lot of criteria. I'm not going to be able to just um, talk about all the different things in one little stream here or a video. Um, I keep trying to read and then. Okay, this is the last one. Let's see. What should be the weekly and monthly goals in terms of percentage? Yeah, that's very much down to the individual. It's your appetite for risk. It's what you really want to make, but it also comes massively down to your account size. When I first started with the baby account size that I had, and this is prior to props, by the way, this is going years back when props weren't around. I had a very small, modest personal account, and I was aiming for around about 5 to 10% a month. And now that I look back, it was probably too high. Generally, 2 to 3% a month with a decent size account, man, you make a lot of money on that. So again, it's circumstantial how big your account size is, but a month, 2 to 3% is more than enough. If you can do 2% a week, that was sort of my benchmark, what I'd aim for when I was sort of doing, day trading slash, intraday trading, that weekly range. I would aim for 2 to 4% a week. But as I've grown, for me, if I can hit 2% a week, if sometimes I can do that in one trade, I am very much happy to close the charts and not look at them again all week. So yeah, it's very much down to an individual. But if you're trying to aim for 10%, 15, 20% a week, or somebody's told you that that's how you should be trading, don't listen to them, right? First thing is you have to acquire the skill set. If you can consistently hit 2% a week, I promise you, you're in the top 5% of the world in actual trading, right? Don't believe what you see on social media. Everybody fakes their results. Everybody only shows you their wins. So do what feels comfortable for you. If you're stressing when you're in a trade, your risk is too much. Trading should be just easy. It should be, if I lose this trade, no problem. I'm risking 0.5%. I'm risking 1%. And that should really be most of your trading 0.5 to 1%. Only when you see a really good, clean A plus setup, my maximum risk is 2.5% on a trade. Sometimes I lose those. But the point is, I have criteria to know, okay, I want to risk and allocate more risk to this trade, or I'm not happy with this. There's certain things in price that I want to look for and they're not currently present. Therefore, that's going to reduce the risk that I'm going to take on this trade. But anywhere between 2 and 4% a week is unbelievable, right? So, don't get caught up in thinking I need a really high percentage. That compounds. Your initial thing that you should be doing is gaining that skill set to hit around 2 to 4% a week, man. You're doing numbers. So if you can get that skill set, nowadays we got props. Nowadays we got, private equity. Focus on the skill set first over then looking at, okay, how much money can I make and what percentage returns can I get, right? You'll go really far with that. I'm going to do the last question. I'm going to go because we've been over an hour. All right. Okay, this guy is being excited. See. If there is a shift not aligned with a higher time frame like the example you gave, how do you know that the mitigation block won't send price back? You don't know. You take a loss. When I hear questions like this, and I get this a lot from my own students, is like, but how do I know this? How do I know this is going to hold? How do I know that this is the right entry? And how do I know it's going to go to that liquidity pool? Bro, you don't know. I don't know. Nobody knows. You have a probability, right? There's a probability of it should go to this level. What happens if it does something against your underlying bias and the criteria that you're looking for in price? What happens if price does something in the opposite direction of how you're reading your price delivery and algorithmic order flow? It means you're probably on the wrong side of the market, right? So if you're in a higher time frame, bullish environment, and you see a market structure shift, and you think, okay, well, I've seen a shift in structure. There's a mitigation block above the market. It's going to go into that mitigation block, and it should sell off, right? Now, there's two ways of doing this. You can just take an entry right at the mitigation block if that's what you're thinking, and in my opinion, it should overlap with at least a fair value gap, another PD array, or a DRT level first and foremost. And again, you can classify high probability structure breaks based on where they are. If it breaks, say you're in a type 2 or a type 1 or whatever you're looking at, and say you're in a sell side delivery, type 2 bearish dealing range, and then you see the market turn around, and then it closes below that 75 DRT level, and it's closed below the previous swing low, and that previous swing low is a second stage of accumulation in the buy program. That's when I'm like, okay, I'm probably in a higher time frame, sell program here, and I'm going to take, that entry lower. But sometimes I'm going to be wrong, right? That's why we have a stop loss. So I'm going to place my stop above that mitigation block. And if I'm using that mitigation block as a PD array and it breaches it, I lose the trade. So, I get this question a lot of the time, is that how do I know for certainty that something's going to happen in price? If you've ever watched ICT stream live, but like sometimes the whole smoke and mirrors with the bragging and I can do this and I can do that and the market's going here and look, I called this and I predicted this and blah, blah, blah. I've been with the guy long enough to know, as brilliant as he is, a lot of the time I'm not sure. I'm going to wait for how this candle reacts here. And that's not him being bad at what he does. That's him using his understanding of how the market's moving. For example, in that example, say you're unsure, right? What do? I'm unsure that price is going to hold at this mitigation block. Wait for a displacement after the mitigation block to give you confirmation, right? So sometimes you're reading order flow. I remember I was in, I can't remember where it was. I'm sure it was on a podcast or somebody. Somebody said that, okay, you should take the entry at that fair value gap. If the fair value gap's your entry, take it. It's one of the worst pieces of advice that I've ever heard. Reason being is because sometimes, that there's different criteria of how strong or weak a fair value gap is going to be. And if you've ever seen ICT trade, he doesn't trade straight from the fair value gap. What does he do? He hovers over the buy and sell buttons and he's waiting. I want to see how price is going to react. And often he won't get the best entry at the fair value gap. Say it's a buy side imbalance and he wants to buy that bullish fair value gap. He will wait. And what's he waiting for? The market to tip its hand to show there's displacement. There's institutional sponsorship behind that move going higher. Then he'll use an institutional order flow entry drill on the next fair value gap to get in sync, right? So it comes back to what I said in the beginning. One of the most important things that you're going to understand is, what does price delivery look like, right? And what's the higher time frame, narrative? What is algorithmic price delivery telling you? And that's information. Anyway, I've waffled a lot. I'm really thirsty. It's been an hour. If you like this and you want me to do this on a weekly basis or something, where I can just sit down and chill with you guys and just chop it up and answer questions, just let me know in the comments. I'd be happy to do that. But yeah, this is just me doing stuff live for the first time. I need to get better at doing it. So, I hope you guys have enjoyed it anyway, and you've got something useful out of it. I know I've covered quite a lot of topics, but there's 10 years worth of knowledge here, and I could talk about this all day long. So yeah, thank you guys for tuning in, and I'll talk to you guys soon. Take care.